All right, live and direct from Matt the Mortgage Guy headquarters here in Sacramento, California. Another live Q&A. So part of the Q&A, you need to ask the Q's so I can give the A. The best conversations, the best content that comes from this channel, I believe, is from great questions being asked by you. So I'll talk about the fact that mortgage interest rates have gone bonkers. Friday and today, last two, open trading days, business days, what that means to, mortgage interest rates as a whole, what I expect to see in the future, so on and so forth. I've got a couple other topics I want to talk about today. I'm going to go over a home values chart, what it looks like for a 10-year time period. If you plan to buy a home and stay in it for 10 years, how many years between 1942 and now do you think that you could have bought a home and seen it decrease in value over a 10-year time horizon? I'll leave you at that. Answer in the comments if you'd like, and I'll take a look at that in a few minutes. But first and foremost, the big headline: mortgage interest rates are up. And with information traveling fast nowadays, it used to be that like mortgage people knew this information. The general public might not know it. Real estate agents might not know it. Word travels pretty fast. And I know people that are looking to buy are tuned in. They're looking at mortgage news daily. My real estate agents that are active and, out there serving clients daily are tuned into something that's given an update on mortgage rates. And so a lot of people reaching out to me today: Matt, what the heck happened? I thought rates were trending down. I thought every time the Fed speaks, we are, going to see inflation coming down, mortgage rates headed down. Well, the last 2 days have proved that, we never know what caused this interest rate spike. In layman's terms, because that's my claim to fame, is keeping it in layman's terms, is there was data on Friday, a jobs report specifically, that came in and basically said job creations was a lot higher than expected. So due to this report is saying, hey, the economy is booming. If the economy is booming, there's not going to be any reason to cut rates. Last week, when I gave a quick synopsis of what Jerome Powell said, if the economy shows strength, that might give us reason to wait a little bit longer to cut interest rates. And the job market, due to this report, whether you agree with it or not, or whether you think numbers are fudged or not, showed a lot of strength. And so that leads to the, forward-looking forecasters to say mortgage rates might not come down as expected. And, so the current market bakes that in. So mortgage rates spiked up. Brian Adams, thank you for joining. Thank you for your support. I appreciate the heck out of you, man. The $10 super chat, super generous, and know that I appreciate it. Just a quick note, because I've had more and more conversations lately. I'm trying to do my part to reach out directly to as many people as possible that go to greatmortgagebroker.com. They connect with me and my team. I want to hear from you personally. I want to talk to you personally. There's been conversations I've had that had nothing to do with mortgage. They just had to do with people paying off debt. I reviewed a refinance scenario for somebody who was halfway through it with another, let's just say it, Rocket Mortgage. And it was really a raw deal. Didn't want to do a cash out refinance with the 3.25% rate that he currently had, just to pay off a small amount of consumer debt. So I think I did my part in saving that person some heartache, going through a refinance with Rocket Mortgage, baking $15,000 into their loan that they're going to pay off in the next couple of years, just for the short-term comfort of paying off this debt, which they're going to pay off that debt when they sell their house. They're just not going to pay $15,000 in fees today so that some kid at Rocket Mortgage in a call center can get a commission paycheck. So with that in mind, I am more excited than ever to serve as much as possible the YouTube community, everyone that supported me. Thank you, Brian Adams, for your support. I am ecstatic that you are officially debt free. I know it probably feels fantastic. Start your down payment fund. It sounds like the tax return is going to be the kickoff to that. And what I will tell you, and I had this conversation over the weekend, I spoke at an event, specifically first-time home buyers, people that weren't sure if homeownership was a possibility. And regardless of how big or how small, 5K tax return, a plan of saving $250 or $500 a month. I'm sure that's easier now that you don't have any debt, right? You don't have a $300 credit card payment going out or $200 student loan payment going out. So you'll be able to save more aggressively than before. If you're intentional about it, you're going to reach your goals a lot faster than if you just say, I hope in 2025, I'm in a great position with a down payment saved to buy a house. You were obviously intentional about getting out of debt. You did that. Now you're going to get intentional about saving up a down payment. My hope for you, mortgage interest rates continue to go down. You save a down payment. Your credit score is reflective of somebody who's responsible with debt and pays it off. And so you got a great credit score. You're going to be in a great position to buy a home if and when the time comes. Conversations I have day in and day out, I won't tell you that, there's a clock that's ticking. You must buy now. Although I do think it's going to get more competitive throughout the year. And as mortgage interest rates go down, I'm never going to pressure anybody to buying at a certain time based on the market. You buy when the time is right for you. For Brian Adams and family, the time is going to be once we're debt free and once we've saved for a down payment. The debt free part is done, Brian. Congratulations to you. Now get to work on that down payment. Thanks again for the super chat, man. I appreciate it more than you know. All right, Caesar, you fire away these questions, folks. I love them. I'll share a slide on mortgage rates just so I can show you what those look like today. But a more interactive live stream is what I'm always looking for. I think it's more fruitful for the viewer. It's more fruitful for anybody who's joining live. Let's get some Q&A rocking and rolling. All right, appreciate it. What's the lowest amount down for an investment property? I heard you can take out loan for renovation added to it. If so, how does that work? It's a multi-layered question, Caesar. If you're buying a single family residence, there are conventional loans available with 15% down. I think that next to nobody does these because the terms are absolutely horrendous. That's the nice way to put it. What I'm going to do here, I got a screen pulled up. Come on, internet. If my internet will cooperate, I will price something for you real quick here off screen. Single family residence, investment property. Let's call it a $500,000 purchase with 15% down, 85% loan to value. Purchase home, and let me see. Great credit. All right. Great credit, remember, 15% down. I'm pricing it off screen. If anybody has any guesses what the rate is going to be, I promise you it rhymes with skate. And that's what it starts with because, it's higher risk to the lender. And there's nothing else for them to do besides charge you more and give you a higher interest rate. So you're going to see both. You're going to see higher interest rate and you're going to see $145 in mortgage insurance for that little 5% gap, right? $145 in mortgage insurance on this $425,000 loan. And to get yourself 8.125, you'd spend at least a point. No, you'd spend at least 2 points. I'm looking at raw pricing where there's not even any, compensation built in. You'd spend 2.5 points to get an 8 1/8. Now, just for example purposes, let's price it with 20% down. Again, I don't necessarily recommend 20% down. 25% is where you're going to see the sweet spot. And so 20% down, it's going to get a little bit better. And so elite 30-year fixed, you'll be able to get, for the same 2 points you spent for 8 1/8, you'll be able to get somewhere in the mid sevens. So that's 20% down. Now quickly 25% down. And I'll show you why 25% down on an investment property is the sweet spot, because we'll just use apples to apples, right? 8 1/8 was a couple points with 15% down, plus you paid mortgage insurance. Call 7 6, a couple points with 20% down. Those same couple points will get you like 6.6 with 25% down. So as you can see, 25% down on investment property is the sweet spot. And quite honestly, it's going to be hard for you to find something that pencils at those 8% interest rates. Maybe you could, maybe it's one of those things where limited capital, you want to give them 15% down and then find a way to refinance later. But I'd say do at least 20 and go for 25%. As far as the second part of your question, loan for renovation and add to it, those type of loans are generally reserved for primary residence, where it's a renovation type loan. There's no true loan that's not, non-QM or hard money to fund renovations as well. Saving $3,000 a month. Man, you're going to be saving money in a hurry, Mr. Brian Adams. So kudos to you. I think you're in Massachusetts. And I think if I remember correctly, your price point isn't too high. So you should be able to save at that clip, 70 grand in 24 months. Plus the tax return this year, plus next year's tax return. You're going to have a good, healthy down payment here quickly. So kudos to you, brother. Great question right here from Nicole Jansen. Is there a cost to locking a rate? There's definitely not a cost to it. So if anybody tells you there's a cost, no. But there is a cost sometimes associated with, any of these products that are lock and shop. How it works, for everybody's knowledge, is 99% of the time you will, and this is for resale homes. I won't talk about new builds. That's a different animal. You are going to be pre-approved. You're going to be looking for a home. You're going to keep an eye on rates. You're going to have an idea what rates are, but you're not going to lock a rate until you've got a home in contract and you've got that fully executed purchase agreement. You get that to the lender. The lender submits the loan, locks the loan, and off you go. The 30 days you're in contract or 25 days you're in contract, you don't have to worry about market fluctuations because you're locked. But anything that's a lock and shop where it's like, I'm going to lock you today and this is good for 6 months, is there's no good products like that available. It's the best way to put it, right? I remember some of these where if today's rate was 6.9, your lock and shop rate was 7.5. And so it's like, what good is there to lock in at 7.5 when rates are better today, especially today? Like, rates should only get better. Rates aren't going to get worse. This recent tick up or last couple of days, people might be thinking, well, look, Matt, they just got worse from Thursday to Monday. They got worse. They went from 6.6 to 6.9, or actually they peaked over 7. Let's take a quick look at that. Because people always like to see this, man. People love them some interest rates. This window. This is a glimpse into what happened Thursday, 6.63. Again, Mortgage News Daily, 30-year average. I think when I cross-reference this to a bunch of people we broker to, it's probably at a cost. It's probably for somebody with a 780 credit score. So keep that in mind. If you've got a 715, you're not paying any points. Like, your rate's going to be higher than this, but you got great credit. You're paying a point to get it. You were getting about a 6.6 last Thursday. That's the second. And then Friday's jobs report. Friday was a disgusting, ugly day in mortgage rates. Today was another bad day. And so we went up real quick, bang and bang. Now we're up above 7% as the average. quite the tick up. I don't think there's a huge need to worry, right? Here's like the mortgage backed securities just for, alert to lock this morning. Got that from my friends over at Mortgage MBS Highway. I'll show you real quick too. Like the red candle means mortgage rates getting worse. Green candle means mortgage rates getting better. Lost about 31 basis points today. We had some green. We had some green up until last Thursday, and then bang, bang, 2 bad days. Got us back to, quite honestly, worse than we've seen in a while. This is early December, We had all this betterment. We lost it all and then some. So rates are probably, let's see if this jives with what Mortgage News Daily. January 24th, where were we at? January 24th. Yeah, see, we're up here at 695. So we're worse than that. We're literally back to like where we were on December 12th from a rate perspective. Let's see if this jives. Yep, there's the 12th, 7.09. So got a lot better. Trended up, trended down, and then ba-bang. Tis what it is, right? It's going to be interesting to see how this affects mortgage applications over the next couple of weeks. We gonna see. All right. My man, Black Box Mobile Fitness. Thanks for joining. Thanks for the support. Go Kings. Let's go light the beam on Wednesday. Well, I guess tonight we're away. Who are we playing tonight? I know Wednesday we're at home. I didn't forget about you, Sharon. I'm going to go up to this question and then keep firing away the question. I'm going to answer every single question. That's my promise. Where do you see investment property mortgage rates in 2 years? This is a great question. And I think I can answer it with at least a little bit of certainty. Most people see mortgage rates trending down, and I see them trending down slower than most. So if the 30-year fixed rate mortgage for owner occupied trends down and goes to low to mid fives in 24 months, the rate for an investment property is going to be 0.5% to 1% higher than that. So we'll see high fives, low sixes on investment property in 2 years. If inflation continues to head down, the Fed does their thing and cuts the Fed funds rate 3, 5, 6 times this year. And so keep in mind, rate isn't the only consideration. Sometimes, like the example I gave where I'm like, yeah, you can get an investment property for 6.6, paying 2 points. Some would say, well, on my primary, I'm getting a 6.6. Yeah, but you're getting a 6.6 and you're only paying 0.5 point for that rate, where it costs 2 points for the investment property. Hopefully that landed. Sometimes I talk about mortgage and I'm like, nobody understood what the hell I just said. But 0.5 point to 1% higher than the owner occupied stuff. So high fives, low sixes would be realistic, slightly optimistic probably. Okay, who we got? Who we got here? What question did I ask earlier? And you guessed 8.75. Was that your guess on the 15% down investment property? Was that what I was asking? This is how bad my early onset dementia is. I already forgot. But either way, if this was a guess on a 15% down investment property is pretty good. 8.75. If the lender's rate stack goes that high. Sometimes, like when I gave you the example of 8.125, 8.125 would cost 2.5 points. And that's the highest the lender would go. Lender's not going to go any higher. And when they cap their rate sheet, I'll tell you exactly what that means. They expect interest rates to go down in the future. So they don't want to write at 8.75 because they know it's going to get refinanced. So they won't. They'll write a lower rate, but charge you for it. That way, even if you're only in the loan for 9 to 12 months, they get paid. Gabrielle Harris, thanks for joining. Yeah, tonight I'm live on a Monday. I've been rocking Mondays for a long time. That is likely going to change because I've got starting on February 26th, elementary school basketball that I'm coaching. I'm excited about it. I'm going to figure out a day. I think I need to do a poll. I'll do a poll and I'll put 3 different dates on it. And anybody who joins live, I want your input because I want to do it on a day that's most convenient for you. I'll be able to do it Tuesday or Thursday and I don't have a real preference on which day because it's going to be Monday. We're practicing. Wednesday, we have games. Man, coaching 4th, 5th, and 6th graders, there's no bigger joy in my life than that. So anyhow, thanks for your support. I appreciate it, Gabrielle. Fire away with any questions you got. Happy to answer them. Caesar, math for cash flow never made sense in California, but now it's impossible. I wouldn't say it's impossible. And, before I totally just quabosh this, I get it. It's hard. And it's not all areas of California. And at times it may feel like, it might feel impossible, but I promise you it's not. A couple things to consider. And I talk to real estate investors about this a lot. I have a lot of real estate teams that work with a lot of investors. In California, what you can do, you can't do in other states, is you can control real estate that appreciates. And you get massive appreciation in places like California, where let's say you buy something and you're like, man, it's impossible. I had to put down 25% just to break even on a property. Yeah, but did you buy something for 500 grand that appreciated 100% in 15 years, meaning it doubled in value? So you added 500,000 in net worth. And, even though you didn't get a lot of cash flow, it broke even at first. Over time, after 2 years, you increased rent. And now you're getting $200 a month in cash flow. Then you refinanced and saved $250 on the mortgage. Now you got cash flow $450 a month. And then 4 years from that, you raise the rent again. And after some time, now after 7 years, you're cash flowing $1,000 a month. And after 15 years, you're cash flowing $1,400 a month. And you've got $500,000 in appreciation. I know a lot of investors in California that, quite honestly, don't care at all about cash flow because they know that if they can control $3 million worth of real estate, which is, 3 to 6 homes, quite honestly, and those things appreciate, they're going to see 7 figures in appreciation in a few short decades. This is a cool thing to look at here. And this is the change in the home values after 10 years. This is a chart that my buddy Barry Habib shared with us. Every single 10-year period, starting in 1942, with one exception, the one exception being 2006. After a 10-year period, the home had appreciated. So literally you couldn't buy, hold for 10 years and see a loss. There's a lot of uncertainty when it comes to stock investing and other types of investing where, you can't get these quote unquote guaranteed returns. Of course, some years better than others. If you bought in 2012 or 2013, you're feeling pretty darn good, right? You got 106% appreciation, 105% appreciation over a 10-year period. And this is based on $100,000, and 10 years later, it's worth 206, worth 204. Imagine if it was 5x that and you had a $500,000 house in California, or some of these Bay Area buyers. I know that, the homes are $1 million. And so if you don't see a lot of cash flow, but don't even take the 100% appreciation, take some of the middle-ish 29, 47%. Like the $1 million property that appreciates 47% in a decade is $470,000 in appreciation. So I don't know. I might be biased. I love me some real estate, but you won't get the cash flow, but you'll get massive appreciation. And you can go to Indiana or to Alabama or to some of these other markets and get cash flow, but I'll let you have $600 a month in cash flow forever. I just want to control a few million in real estate that's going to appreciate. And every decade, I'm going to get another 500, 600, 800,000 added to my net worth while also paying down the debt, which, by the way, I'm not paying down. My tenants are paying that debt down. So that's the flip side of that coin, which makes California real estate investing attractive to some, not all. All right. Thanks for talking with Zuber about the refi yesterday. If I have an investor rate in the high sixes purchased last year, when is the best time to look into a refi? On an investment property, you probably set for quite some time. When I went through that exercise, I think it was my friend Sharon Tran that was asking about investment property rates in 2 years. To get the mid sixes today is going to cost you, even with a 70% loan to value, whatever you're sitting at on the investment property. The high sixes. Yeah. Depending on how much you owe, because the bigger your loan amount, the less rate discount you need for it to make sense. I had somebody reach out to me who's got a $644,000 balance. They've got a 6.875 and they've got mortgage insurance. They want to wait until it's a 5.5% rate. I try not to be too much of a salesman, but I'm like, listen, like you going from 6.875 to 6.124 and removing mortgage insurance saves you $550 a month. I'd probably do that refinance right now. Who knows what's going to happen to interest rates? It might be 3 years, 5 years, 8 years before you can get in that specific person's scenario a rate in the mid fives or low fives. And so don't pass up on the $550 a month in savings now. So the short answer, BuzzTune, is nowhere in the immediate future, right? I would say, in the high sixes, anybody who's trying to sell you on a refinance, even if you owe 500,000 plus, there's going to be enough cost baked into refinancing in the mid sixes that it won't make sense. And mid sixes, you're only going to save a couple $100 at most. So I'm always happy to look at it, man. Fire me an email. I've been doing more and more of these, and I truly like it. If you fire me an email, matt@mtmg.com, you don't want to go through my whole form at greatmortgagebroker.com. I get it, right? Just fire me something off and say, here's what I got. What do you think? I'll give you honest advice. I owe 452. I'm at a 6.875 on investment property. I'm going to tell you, leave it alone. Reconvene. You see mortgage rates getting, significantly better. Mortgage News Daily for a primary is showing a 5 in front of it. Let's take a look and see what you can get on investment property. But for the short term, near term, leave that bad boy alone. All right. Maria joining from LinkedIn. Thank you for the kind words. I appreciate it. The information I got in my brain is just based off being in this. I forgot to post something about like a 10-year anniversary in mortgage, because February 1st of 2014 was when I originally got my mortgage license. So it's been a decade. And more than ever, I'm having fun with it. I'm having fun talking to people every day, providing value. I'm getting people from companies that are going through training that are watching my how to escrow accounts work on YouTube. That thing's got like 130,000 views. And I'm like stoked that it's, being watched by anybody. The fact that people have it involved in some of their trainings to train agents on how to escrow accounts work, that was really, really cool. So I appreciate all of you, all the kind words. I'm gonna keep it up. BuzzTune, thank you, sir. The super chat's much appreciated. It's really, really my pleasure. So thanks for that. That I get to brag to my kids, and I'm getting super chats on YouTube to a 10-year-old. That's pretty cool. Joe Reams, Joe Mortgage, thanks for the kind words, man. I appreciate it. Hope all is well with you. 2024 is going to be a great year. I bet real estate transactions are up 20%. I bet that those of us who are left standing in the mortgage industry are stronger because of how tough 2023 and 2022 honestly both were. And so cheers to an awesome year, man. All right. Do you think I would be able to get a $500,000 loan on just my income of 80K with 20% down and a 740 credit score? Should I plan on using my wife's income? She makes 70. Off the top of my head, Brian, I'm going to say you're probably in good shape. I'm going to run some numbers on my phone here, and I'm going to say 500K, you're going to put 20% down, and 500, I'm going to use a rate of 6.25, even though by the time you do it, it might be lower. Hopefully you're using a great mortgage broker like Matt and team. You're in Massachusetts, homeowners insurance, let's call it $1,800 a year. It keeps getting more expensive every day. Annual property taxes, what are they, 1% in Massachusetts? So just some rough math, $400,000 loan, 6,625, 2,561 is the principal and interest. Taxes, insurance, you're all in payment of like 3127. That view, can people see that? Come on, zoom in, baby. 3127. And if you make 80 grand a year, this is a quick pre-approval, right? This is a live pre-approval divided by 12. Call it 6,700 a month. And what I say the payment was 3127. It's going to be tight. You said you've got no debt, and so 6,700 in income. Yeah, that front end ratio, meaning just the mortgage payment, is going to be like 45% of your income. So you might need the wife. And depending, like, it's all scenario specific. Like, should we have both of us on the loan? Should we have just one of us? If you can qualify with one, great, because then the second one's not liable. It opens up things if things go really well and you want to put some loans in your name, some in her name, and you guys each have the ability to get 10 mortgage loans. If things go bad, yours is the only one that's affected, not her credit score. And then, I think that it's going to be tight when the time comes, when you get pre-approved, you'll be able to, and I have people come to me a lot. I'm going to get pre-approved on my own. I'm going to see exactly what I qualify for. And we go through that. And you know what, Brian, 20% down based on today's rate, we can qualify you up to 480. And then maybe you find something 480 or lower. If you want to qualify for more, and you're like, hey, we can handle up to a $3,500 payment, so let's add my wife on there, and we'll be able to show you, with your wife on there, you're going to qualify for over 600, more than you want and need. If you buy something at 525, here's the monthly payment. Buy something at 550, here's the monthly payment. And then you fit that into your budget. But just rough math, not knowing specific property tax and homeowners insurance info, it'll be tight, but close to 500 with just you. Caesar, you have about 10 years left on a property. My rate is at 2%. What product do you recommend to pull equity for another property? Really, in your scenario, you want to look at some sort of home equity line of credit. A lot of different places do it. None of them have fantastic rates. If 30-year fixed rate debt on the first mortgage is 7% today, expect to pay double digits for any sort of home equity line of credit. It's a fixed rate. Sure, you can get 9% or 9.5% if it's an adjustable rate, but with no clear path to pay it off super quick, I don't recommend the adjustable rate stuff. Also, something to think about is some people get really, really attached to, like, I've got this thing and it's going to be paid off in 10 years. I get it. Like, you're on the back half of the amortization schedule. You've got, 70% of the payment is going towards principal and it's paying it down. But if you owe 80,000 on that mortgage and your trapped equity that you're trying to access is there, and you don't want to touch it with any sort of refinance, because you've got 2%, keep in mind the 2% is on 80,000. So like that small of a loan amount, and again, I'm just guessing in your scenario, it might be that you owe 225 still. If you owe 80 and you're looking to access 300, and the 300 you access is going to allow you to go get 15% returns or 20% returns on a great investment, don't automatically say it's a non-starter to refinance and have a $380,000 balance at 6.5%. Because in the case where you've got 80 grand at 2% and you go pull 300 and pay 10.5% on a home equity line of credit, that isn't as good from a financial perspective as cash out refinance, $380,000 new balance, 6.5% on all that debt, and you go out and deploy that 300,000 to go make a bunch of money. Again, it's going to depend on the opportunity. It's going to depend on a lot of different factors, how much you owe, but there's no hard and fast rule. There's, the lower your rate and the bigger your balance, the less likely it is that you want to refinance and touch that first. And like, I had somebody that we just did a home equity line of credit for. He had a 15-year rate at 1.875. Shout out to, what's his name? Probably doesn't want me to mention his name, but, just seeing that 1.875, it's sweet, man. And in his case, it made all the sense in the world to go get out 12% home equity line of credit. I think we got a better rate than that, but anyhow, a lot of different moving parts to that one. All right, glad I opened your eyes. Hit me up, man. Matt@mtmg.com if you want to dig into your scenario. I'm happy to help. What? Gabrielle Harris, you better have mistyped here. Our new construction build lenders, D.R. Horton incentives, 3.9 interest rate and 10K towards closing costs, just bait, or would you recommend using outside lenders? Gabrielle, I'm gonna give you some really honest advice, and it pains me because in my market, 27% of the home sales are new builds, but D.R. Horton, is it D.R. Horton? I think it might be. And they've got like DHI as their in-house lender. They own the lending company. They have the ability to, and this is the thing, they want to sell their homes at a premium price, and price is what matters because price will dictate what they can sell the next house for and the next house and quite literally the whole development. So they'll offer you fantastic incentives that truly can't be touched by anybody else as a way to get you to pay the premium for the house. And that's the thing is, the $700,000 price tag or whatever they've got attached to the house, depending on how hard they're trying to sell it or how bad they need to sell it, their incentives, they can write at a loss. And the mortgage company doesn't have to make money as long as that price is met. They would much rather sell it to you at $700,000, lose $15,000 by writing a loan that quite honestly loses them money, than having to lower the price to $680,000, because then the other 100 homes in the development are going to have this comparable sale of $680, and it's going to lower the value of the other 100 homes by 20 grand. And so it's not going to be, one concession to you of 20 grand, it's going to be a $2 million hit to the value of the community. And so they keep the price at 700. They offer you an incentive, like a great interest rate, where one, they've bought some forward commitments and they have some interest rates maybe still left over that they bought in 2022. But nonetheless, the short answer is run that by an outside lender like myself or somebody else. We're happy to take a look. More often than not, I'm telling people, take that. It's a great deal. And the other piece of advice I'm giving people is take it with a little bit of strategy, because like Sharon and others have seen, they're going to have different options for you. Take an option that is a great deal for you, doesn't have a lot of baked in cost, and they're going to play ball. One thing that I've seen from a lot of these in-house lenders too is sometimes they jack up the cost and then they give an incentive, kind of like Kohl's, give you a $99 sweater and give you 60% off when really the sweater only should cost $39 to begin with. Try to get those incentives from the builder and use an outside lender, which isn't always the case, but I've got some clients who were able to do that. So anyhow, Sharon wants to know if that 3.9 is fixed or an adjustable rate. I would guess 3.9 has got to be an adjustable rate. The 4.99s and the 5.49s, I've seen those at builders. I've never seen 3.9, but if you like the development, if you like the area, take that sweet rate they're offering. And I'm gonna wish you well. I've even had friends use the Builder Center. All right, I got to go. I got a lot of work to do. Thanks for joining. I appreciate everyone who joined. See me next Monday, the Monday after, and then we'll decide going forward from there what day we're going to do this on. But I enjoy it, so I'm going to keep it up. Talk to you soon. Bye-bye.